traders at Access Bank say that they expect the Treasury Bills market to close the week with mixed sentiments due to investors' interest in the newly issued one-year paper. Senator Audu, a fixed income trader at Access Bank, joins me now for a wrap of the fixed income market today. Thank you so much for your time, Senator. Let's first start with that one-year paper and what's driving that interest there.
Thanks, Kenneth. Thanks for having me. And so as you rightly said, there was an auction on Wednesday, an NTB auction conducted by the Debt Management Office, the DMO. So at that auction, 3 bills were issued, the 91-day, the 182-day, and the 364-day. So the 364-day maturity is an 8 June 2023 maturity, which is the newly issued Treasury bill. So at that auction, the total subscription was 362 billion, as against the 167 billion that the DMO offered. The DMO sold just 183 billion, which is significantly less than the subscribed amount. So we saw that immediately following that auction, market participants who lost out began to show their bids across the curve. With regards to the stop rates, we saw the stop rate maintained on the 91-day at 2.5%. We saw a decline on the 182 and 364-day bills by 5 basis points each. On the 182-day, we saw the stop rate decline from 2.89% to 2.84%. We saw a similar decline on the 364-day maturity from 6.49% to 6.44%. So we saw that newly traded bill trade at around the 6% handle in the secondary market.
But when you look at how it compares with previous auctions, what trends are you seeing here?
Okay, auction on auction, as I explained, we saw that decline by 4 basis points on the 1 year. For the auction before this one, we saw a significant rise in rates, and that was largely because the market was mostly illiquid. So we saw very few bids, and consequently the DMO had to borrow at higher rates. So we saw rates rise from 5% levels, from 4.7% on the 364-day maturity actually, to 6.49%. We didn't see a similar hike this time, only a slight decline.
All right, but looking at the second quarter as a whole and how the market has played out so far, how would you compare the opportunities playing out in the fixed income place with that of what we've seen play out in equities?
Fixed income, the fixed income and stock in the stock market don't trade based on the same fundamentals. So for the fixed income market is largely driven by the actions of our regulators, such as the central bank and the Debt Management Office, as well as expectations around market fundamentals, such as inflation. So at the last inflation figures, for example, we saw an increase from 15.92% to 16.82%. The market had expected an increase in the CPI figure, and that had been mostly priced in. So we didn't see that impact the market significantly. Although the market didn't adequately price it in because the rise in rates and the CPI was more than expected. So we saw initial jitters in the market, so we saw significantly higher bids than when the market was trading, but we saw the market calm over time. So now we're back to normal trading.